EPK Capital presents Deep Dive on T-Mobile. Hello everyone, welcome to EPK Capital's Deep Dive video. I am your host, Rutvik. In this series, we analyze one company each day based on the security analysis by Benjamin Graham. Today, we are going to talk about T-Mobile. What happens when a rebellious wireless company, a German telecom giant, and a rival carrier walk into a merger? The result is T-Mobile US, the self-proclaimed Un-carrier, a company that has strategically positioned itself as a dominant force in the American telecommunications market. The Un-carrier's rise, from challenger to contender. T-Mobile US, Inc., a wireless network operator headquartered in Bellevue, Washington, has a history marked by strategic transformations. The company was founded in 1994 as VoiceStream Wireless by John W. Stanton. Its early operations focused on providing wireless personal communication services, PCS, in several western and southwestern states. In the year 2000, VoiceStream expanded its footprint by acquiring two regional GSM carriers, OmniPoint Corporation and Aerial Communications, Inc. A pivotal moment in the company's history occurred in 2001 when Deutsche Telekom, DT, a major German telecommunications company, completed its acquisition of VoiceStream Wireless and the southern U.S. regional GSM network operator PowerTel. This merger was valued at an astonishing $35 billion and $24 billion respectively. Following the acquisition, VoiceStream Wireless was rebranded to T-Mobile USA, Inc., aligning it with Deutsche Telekom's existing global T-Mobile brand. However, the most significant strategic move in recent history was the 2020 merger with Sprint Corporation. This event marked a substantial restructuring for the company. Rather than a simple consolidation of customer bases, this merger was a highly calculated maneuver to acquire Sprint's critical mid-band spectrum assets. This strategic accumulation of spectrum has enabled T-Mobile to build a superior, multi-layered 5G network that its CEO has described as the envy of the 5G world. A network that is widely emulated, but never quite duplicated. This foundational advantage in network technology has directly contributed to the company's ability to attract and retain customers, which is a fundamental driver of its business today. T-Mobile US is currently led by President and CEO Mike Sievert, who is supported by a team of 16 C-level executives, presidents, and executive vice presidents overseeing functional areas of the business. The company's organizational structure is highly hierarchical, with the CEO at the top, followed by three presidents leading the business group, consumer group, and technology divisions. The company's Un-carrier identity is not just a marketing slogan, it represents a core cultural philosophy. The company's leadership has focused on flipping the industry playbook by delivering more for less and prioritizing customer needs, a strategy that has proven effective in an era of exploding data usage. This disruption-focused culture has fostered customer loyalty, as evidenced by T-Mobile's industry-leading postpaid phone churn rate of 0.91% in Q1 2025. This cultural differentiation, which is difficult for competitors to replicate, serves as a powerful and enduring asset. As of April 2023, the German company Deutsche Telekom AG holds a 51.4% stake in T-Mobile US, making it the largest shareholder. This position grants Deutsche Telekom significant influence over T-Mobile US's strategic direction and corporate governance. A decade of financial transformation. The financial journey of T-Mobile over the last decade tells a compelling story of a company that has leveraged its strategic decisions to achieve impressive scale and profitability. To understand this narrative, it is necessary to analyze the key numbers that show its growth and the challenges it has faced. A review of T-Mobile's annual revenue shows a significant growth trajectory, particularly in the years following the Sprint merger. Revenue for the 12 months ending June 30th, 2025 was $84,052 billion, a 6.27% increase year over year. Annual revenue grew from approximately $78.5 billion in 2023 to $81.4 billion in 2024, representing a 3.62% increase. This growth is projected to continue, with forecasts anticipating revenue of $98.1 billion by 2028. The company's profitability has also seen a dramatic increase, especially in the last few years. T-Mobile's earnings per share, EPS, for the 12 months ending June 30th, 2025, was $10.59, marking a 32.71% increase year over year. The annual EPS figures illustrate a significant acceleration, jumping from $2.06 in 2022 to $6.93 in 2023, a 236.41% increase, and then to $9.66 in 2024, a 39% increase. This explosive growth in earnings is a direct consequence of the operational and financial synergies realized from the Sprint merger. After the initial costs of integrating the two companies' networks and operations, the combined scale and reduced redundancy have translated directly into the bottom line, accelerating profitability at a rate far exceeding revenue growth. The company's operational efficiency is also highlighted by its profitability margins. T-Mobile maintains a healthy gross margin of 63.68% and a net profit margin of 14.53%. The robust increase in net operating profit after tax, (NOPAT), of 18.98% year over year from $12.55 billion to $14.93 billion further indicates strong operational efficiency and enhanced profitability. T-Mobile's financial position is defined by its significant debt load. Total debt for the latest quarter ending June 30th, 2025, was reported at $118.7 billion. This substantial debt is a result of a calculated, multi-year strategy to finance the Sprint merger and the aggressive, capital-intensive build-out of its nationwide 5G network. The long-term debt has increased over the past 5 years, reaching $79.12 billion in 2024, and the company's debt-to-equity ratio stands at a high 136.1%. However, a closer look at the company's cash flow reveals a more nuanced picture. Despite the high absolute debt figure, the company's debt is well covered by its operating cash flow, with a coverage ratio of 30.7%. Furthermore, its interest payments on the debt are well covered by its EBIT, earnings before interest and taxes, with a 5.5x coverage ratio. This shows that the company is generating sufficient earnings and cash to service its financial obligations. The debt is not a sign of financial distress, but rather a strategic lever for growth. The company's confidence in its future cash flows is also reflected in its decision to begin paying a dividend. A visual summary of T-Mobile's financial trajectory can be seen in the following table. The Value Investor's Perspective, a Benjamin Graham analysis. For value investors, the goal is to find stocks trading below their intrinsic value, thereby providing a margin of safety. Benjamin Graham, the father of value investing, developed a formula to determine the maximum price a conservative investor should pay for a stock based on its earnings and book value per share. In this equation, EPS is the earnings per share and BVPS is the book value per share. The constant 22.5 is derived from a conservative price to earnings (PE) ratio of 15 and a price to book (PB) ratio of 1.5. When attempting to apply this formula to T-Mobile, a significant challenge arises. The company's latest trailing 12 months TTM EPS is a healthy $10.59. However, a review of T-Mobile's financial data reveals a negative tangible book value per share of $44.99. Since the formula requires taking the square root of the product of EPS and BVPS, it is impossible to calculate a real number with a negative book value. This limitation is not a sign of a failing business. Rather, it highlights the inherent limitations of this legacy valuation model when applied to a modern telecommunications company. T-Mobile's most valuable assets are not physical plants and equipment, but intangible assets, specifically its vast portfolio of spectrum licenses. The company has invested billions of dollars in these licenses, which are the very foundation of its nationwide 5G network and its long-term competitive advantage. These assets are not fully captured in the traditional calculation of book value, leading to a negative tangible book value. The Graham number, therefore, is not a suitable metric for valuing a company whose core value lies in these intangible but critical assets. Given the challenge with the Graham number, a more relevant valuation metric is the price-to-earnings (PE) ratio. The PE ratio compares a company's stock price to its earnings, indicating how much the market is willing to pay for each dollar of earnings. T-Mobile's current PE ratio is 23.7722. This is higher than its primary peers, Verizon, 10.25, and AT&T, 16.81. This premium valuation suggests that the market has higher growth expectations for T-Mobile compared to its rivals. However, when viewed in a historical context, the current PE ratio is 31% lower than T-Mobile's own 10-year historical average of 34.69, and also below its 3- and 5-year averages. This presents a nuanced picture. While the stock is valued at a premium to its direct competitors, it may be trading at a discount relative to its own past valuation. The case for and against, bull versus bear. Every investment decision involves weighing the potential rewards against the risks. A balanced analysis requires a thorough examination of both the bullish and bearish arguments surrounding T-Mobile's stock. The core disagreement between the two narratives lies in their interpretation of the same data, specifically regarding the company's debt and its aggressive business strategy. The bullish argument for T-Mobile is primarily built on its technological superiority and its consistent ability to capture market share. 5G and network leadership. T-Mobile is widely considered the leader in 5G, particularly due to its aggressive build-out of a mid-band centered network. This has resulted in the largest, fastest, and most awarded 5G network nationwide, providing a significant competitive advantage over rivals who rely on legacy infrastructure. Unrivaled subscriber growth. The company has consistently outpaced its competitors in subscriber additions, particularly in the high-value postpaid segment. In Q1 2025, T-Mobile added 1.3 million postpaid net customers, its best first quarter ever. The company's postpaid market share has grown from 30% in 2020 to 36% and is projected to reach 40% by 2026. New growth avenues. T-Mobile's aggressive expansion into fixed wireless access, FWA, is a major growth driver. The company led the industry in FWA growth in Q1 2025, reaching 6.9 million subscribers and projecting to hit 12 million by 2028. Strong financial performance. Bulls point to the accelerating earnings per share, EPS, growth, and strong financial forecasts as evidence of the company's profitability and future potential. The initiation and increase of a dividend also signal management's confidence in future cash flows and financial health. The majority of analysts hold a positive outlook, with a consensus rating of buy. The bearish argument for T-Mobile acknowledges its successes, but focuses on the potential risks that could impede its long-term performance. Intense competition and pricing pressure. Despite T-Mobile's leadership, the telecommunications market remains intensely competitive. The bear case suggests that rivals, particularly Verizon and AT&T, will escalate device promotions and pricing wars in response to T-Mobile's gains. If T-Mobile is forced to respond in kind, it could face increased margin pressure that would undermine its profitability. High debt burden. The sheer size of T-Mobile's total debt, over $115 billion, is a significant risk factor. While the company's interest and cash flow coverage ratios are currently strong, the bears would argue that such a high debt load limits financial flexibility and makes the company vulnerable to rising interest rates or a broader economic downturn. The high debt is seen as an inherent risk that outweighs the benefits of its strategic use. Operational and regulatory risks. The company is also exposed to the risks of unforeseen events that could disrupt operations or a changing regulatory landscape that could impose new restrictions or costs. The final word. T-Mobile US is a company that embodies a high-growth, high-leverage business model. Its success has been driven by a deliberate and disruptive strategy that has transformed it from a perennial third-place player into a market leader in the critical 5G and fixed wireless access sectors. For a potential investor, the analysis of T-Mobile presents a clear set of trade-offs. The company's strong growth story is supported by its leadership in next-generation network technology and a proven ability to attract and retain customers. The acceleration in earnings per share and the positive analyst consensus further reinforce this optimistic outlook. However, this growth has come at the cost of a substantial debt burden. While the company is well equipped to service its debt obligations at the moment, the sheer size of the debt represents a potential risk, particularly in a less favorable economic environment. Furthermore, the company's history of data breaches poses an intangible risk to its brand reputation and customer trust. Ultimately, the decision to invest depends on an individual's risk tolerance and conviction in T-Mobile's ability to maintain its growth trajectory and effectively manage its significant debt load. The company's stock, trading at a premium to its peers but a discount to its own historical valuation, presents a complex picture. This report has provided a comprehensive overview of T-Mobile's story, from its foundational history and financial health to its technical performance and investment risks, to enable a more informed perspective. This report is for informational and educational purposes only and does not constitute financial advice. The analysis is based on publicly available data and professional interpretations. Investment decisions should always be made with the guidance of a qualified financial professional after conducting your own thorough research. The past performance of a security or financial product does not guarantee future results or returns. And that's all we had for this video. Thanks for watching. If you found this video valuable, please hit the like button, subscribe to our channel, and let us know in the comments which company you'd like us to analyze next.